Hi, we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. My name is Alex Matthew. We're going to talk about the expenses that you incur when you invest in mutual funds today, and this is described as what you call a total expense ratio. How does this work? How do you determine how much you're paying? And how much of a difference does it make if you're paying much more in one scheme versus another scheme that's giving you similar returns but which costs less? We'll talk about all of that and more. And we've also got a conversation on the show lined up to talk about the soon-to-be launched iPhone 16e. Does it make sense to upgrade to that? Join me today at the start is Kaustubh Belapurkar, who is Director and Head of Fund Research at Morningstar India. Hi Kaustubh, thanks so much for taking the time. This is not something that people look at very often. And I know that people look at expense ratio, total expense ratio when they're investing in passive mutual funds, but in active mutual funds, people tend to look at the past returns first and maybe down the line they will also look at expense ratio. Is that something that you have noticed as well?
Yeah. Firstly, hi Alex, and thanks for having me on the show. I think a very interesting and a very important conversation that you kind of broached upon today. When we think about the costs of investing, right? Because obviously, right, like you rightly said, when it comes to passive strategies, there's a very keen eye in terms of what are the costs, what is the TER or the total expense ratio of the fund, but probably not as much attention is being paid to it when you look at actively managed strategies, right? To our mind, costs are an important bearing when you think about making investing decision. They shouldn't be the starting point of an investing decision for sure. I mean, you're not simply going to just say, I'm going to pick the cheapest fund and invest because it is the cheapest fund. If a fund meets all the criteria and the merits, in amongst your portfolio requirements, and there are funds, there may be a couple of funds that meet the same criteria, they're almost alike, but one is significantly more expensive in terms of expense ratios than the other, then, of course, that cost consideration should be taken, even if it is an actively managed fund. So I think it's an important conversation or an important data point to look at. And definitely, I think investors need to think about, what is the cost that's embedded in their funds when they're looking to invest.
About the key details here, and for those people that are unfamiliar with the concept of total expense ratio, let's first define that and how it is measured and what the implications are. So first, what is total expense ratio and where do you see this? And also, of course, explain the fact that your net asset value, which is your per unit cost, is what you see after the deduction of that total expense ratio.
So let's start with the basics, right, Alex? So when you think about the total expense ratio, what is this? This is literally the cost that you are paying to buy into the fund in terms of, it's the cost of fund management. So there's there are various components within what we call the TER. Obviously, there's management fees that's there. There's auditing, there's platform fees. There is a distribution commission that's embedded typically in a regular plan if you're working with a mutual fund distributor. All of these are components of the total expense ratio, right? So let's just assume that there are two funds, and like we said, the two funds are running exactly the same strategies, they're buying exactly the same stocks. Now, let's say a hypothetical example that you were to invest 1 lakh rupees in Fund A and Fund B, which had exactly the same pre-fee return, what we call as the gross returns in the fund. So they bought the same stocks in the same quantum, held them or sold them at the same time. So they mirrored their decisions, right? But Fund A had a total expense ratio of 1.5%, and Fund B had an expense ratio of 1%, right? So 50.5% cheaper than Fund A when we think about it. Now, had you stayed invested in that strategy for a period of 10 years, that 1 lakh rupees on the total expense ratio, and we'll talk about how that that works out from an investment basis, your net return on an average would have been 9.5% in Fund A. If you just simply do a math of deducting 1.5% from the gross returns, whereas it would have been 10% net return in Fund B, right? And when you look at the final value of your 1 lakh investment after 10 years, Fund A would be about 2.47 lakhs and Fund B would be about 2.59 lakhs. So almost 4.7% difference in the final value over a 10-year period. So, the larger the value that you invest, the percentage change is pretty significant, right? If you're getting almost close to 5% more through a fund that's cheaper and it compounds over a period of time.
Yeah.
Right? So that's where obviously costs become an important consideration because they are, in a way, from an investor's perspective, they are reducing the return that you see in the NAV of your fund, right?
Yeah.
Now, how does that get accounted in? I think that's important for investors to understand. So there is obviously a TER that a fund carries, and there are SEBI guidelines, and we'll probably talk about that a little later down as to how some of these slabs are decided. But there is a TER that a fund carries, right? And the daily NAV that the fund publishes would account for literally a daily accrued cost of that expense. So let's just assume that the fund expense was 1.5%. Which is the annual expense ratio. It would be broken down into sort of a daily percentage, and the NAV would reflect, already accounting for the expense ratio of that fund. So when you buy into it, you already adjusted for the expense ratio. But as I just showed in the earlier example, the higher the expense, the lower the net return to the investor would be, which would then get, over a period, the difference can get compounded quite significantly. If you're investing, say, in an asset class like equities.
Yeah.
Even in asset classes like debt, right? It makes a huge delta.
100%. 100%. So it makes a big difference. I do want to point out the point that you made, Kaustubh, on regular versus direct, and this is something that we harp on very, very often. If you're watching programs like this, if you're getting a sense of how you should invest, and if you're doing your own research, if you are DIY, then it would be criminal for you to be also doing regular, because the difference between a regular and a direct scheme is effectively about 50 to 60 basis points, or 0.5 or 0.6 percentage points. Yes. Which Kaustubh just pointed out. And in that illustration over a 10-year period, the gap, and you're paying 4.7% more, or rather your returns are 4.7% less in that situation, right? So you need to understand that you would be paying much more, and this has a huge bearing on your returns. But to the point on how this is calculated, and the fact that there is a graded system in which the total expense ratio is mapped. This is regulatorily driven. The Securities and Exchange Board of India has a threshold for assets under management, after which point each scheme has to reduce the maximum total expense ratio that it can charge. Incidentally, Kaustubh, just last week, you had the SEBI chairperson at an event speak about why certain schemes are launched. And the implication, and what she mentioned, was that because you have only one scheme in certain categories that is allowed, mutual funds have one small cap fund, one flexi cap fund, one mid cap fund, but they launch a lot of thematic funds because they can. And because of this very calculation, you have more schemes that are offered, and a lot of distributors do go out and sell those, maybe to the detriment of the investor. So let's understand how this grade works.
Sure. So actually, Alex, that's very important. But I just want to maybe highlight one very important aspect that you touch upon, the regular versus direct sort of conversation before I get to you answering the second part of your question. It is important, and costs definitely will make a difference, and a huge difference, like we highlighted. But I think it's also important to understand that, if you as an investor don't have the wherewithal to make an investing decision, right, by yourself, because you're driven by behavioral biases, or you don't have the time, or you don't have the knowledge to invest, and you end up making wrong investing choices, that can actually prove to be a lot more expensive than simply the saving that you're doing by going direct.
Oh, 100%.
So I think
I'm not suggesting, Kaustubh, that you don't take advice. You must take advice.
Yes.
But then decide whether you are going to go to a distributor and go knowing full well what you are paying for. And also the alternative, of course, is to go to a fee-only advisor where you get a suggestion and then you go ahead and you choose what you need to choose based on the advice that you're given. But 100% get advice that you need. But let's make that second point as well, Kaustubh, which is how is this calculated and what is the grade?
Sure. Perfect. So just setting some history to what SEBI did, right? So I think this was about maybe 5-6 years ago. I'm forgetting my timelines a bit, but essentially what they looked to do was, given that the industry had grown significantly in terms of assets, obviously, they had some previous slabs in place which were in existence for more than a decade, I think somewhere in the late 2000s. And, in terms of where the current assets of funds were at, those slabs or threshold were almost meaningless, where they define, how much expense you could charge on a certain, incremental asset base, right? So they redid this exercise saying that looking at where currently the industry stands at, they defined what should be the maximum allowable total expense ratio on different size of the fund that they can charge at. Remember, this is at a fund level, right? So if there is a fund which is perhaps only a couple of thousand crores, they have the ability to charge a higher expense ratio as compared to a fund that is say 50,000 crores. Like if I just take an example, and these slabs work almost like an income tax slabs, right? That at every slab you'll get charged, they can maximum charge that percent, and as the slab goes up, the percentage they can charge comes down. So when you look at the blended level, this is purely just as an example basis for an equity fund. A 2,000 crore fund can potentially have a TER of 1.9, and then there's some additions above that, but the base TER, as they call it, is 1.9%. But a 50,000 crore fund can maximum charge a base TER of 1.34, right? So that's a significant difference between the expense ratio, a smaller fund like a 2,000 crore fund versus a 50,000 crore fund can charge. And these are limits defined by SEBI, and obviously all asset managers, follow that to the T in terms of maintaining the TER below or at that maximum allowable band, right? Now, the challenge obviously is because there is a fund level, there are, greater incentives or, sort of if someone who wants to invest in a particular strategy, but it is, it's cheaper and, if someone were to get into a more expensive or a smaller fund, there will be a greater TER charge to it. And I think the conversation that's been happening is, are a lot of monies moving to new funds because A, they're smaller and they have the ability to charge larger TERs. And that's perhaps why some of the needle is moving there. And that's probably where some of the criticism is coming from.
Yes.
But I think SEBI's done this wonderful thing at the end of last year where they announced that if there are switch transactions that are happening from one fund to another, essentially you would earn the commission of the earlier sort of
whatever's lower,
fund.
whatever's lower.
So
right?
there's no arbitrage, that limit. And I'm not saying that everyone on the street is doing it, but perhaps there were a few bad apples who were driven by that. And I think SEBI's looked to address that issue.
But Kaustubh, on that point, I do want to highlight here that if you have a distributor, to that very point that Kaustubh just mentioned, if you have a distributor that is telling you to redeem from an existing scheme rather than switch to another one in that same fund house, then what is probably happening is it's possible that they're getting you to do so because they want a higher commission. It's possible. So ask the question, why are you being asked to redeem out of a scheme? Look at the performance, look at what it has done for you, and look at where it fits in your portfolio. And if it ticks all of the boxes and you're still being asked to sell because of this new shiny scheme that is being launched, or if it's in the new fund offer stage, then perhaps it's a question for you to ask, why are you being asked to do so? Because if someone's pushing you to do something, you need to understand whether or not they're being driven to do so for some reason or the other. It's something to pay attention to. Kaustubh, thanks so much for joining me. Was there another point that you had to make?
Yeah, just to add on to your point, Alex, I think a very pertinent point, because what's happened in the last, I think, couple of years is, like you rightly said, there have been so many NFOs, and several of them probably sector thematic funds, which don't necessarily make merit in every investor's portfolio. Right? These are very, very select funds that only a nuanced investor or specific portfolio should have. So you as an investor should definitely ask that question if you're being recommended a scheme which is new and perhaps a little more gimmicky than what is beyond what's already in your portfolio, then why do I need this fund and what purpose does it serve that's not being served from a fund in my existing portfolio already? So I think that's an important thing that investors need to focus on. And beyond that, I think that's really let the money ride for them and kind of ride the market cycles.
Yeah, absolutely. Couldn't have put it better. Kaustubh, thanks so much for joining me on what I think is a very important conversation to have, and pleasure having you on the program.
Thanks, Alex.